which is a good and a bad thing. Sometimes it takes away from client responsibilities. It means extra hours in the day, extra hours in the week, but it is what it is. But I think in this world where we have so much scrutiny, that the board of directors really needs to take a look at all of these responsibilities and take them to heart. So what are the duties? These are actually 7 duties, and they are outlined in statute. And in our investment policy statement, we actually list each of these and then actually take the verbiage from statute and put it behind them. And it's interesting, I've had conversations with board members and have said, you read the investment policy, and they said, we didn't even know that those were our duties. We kind of knew what they were, but to have them in writing and have them fully explained to us was a very eye-opening and in many instances a very sobering experience to understand the brevity of the responsibility that they had in their boards of directors. So we're going to go through them real quickly. Obedience. That means that we have obedience to the organization and to our donors. And that also ties in with loyalty. We put all personal interests aside, and I've been on boards where you have someone who's wavering on that personal interest. You can kind of see it. That's why we have conflict of interest policies. They should be in writing, they should be reviewed annually, but that helps us to avoid issues with obedience and loyalty. Duty of care. And I think this is probably the most telling one when you actually read the statute. Because what does it mean to have the duty of care? And here's where they actually use the phrase prudent person. And then they talk about a number of factors that go into play for someone to be a prudent person. And so I think that's why it's important for us to actually write it out in our investment policies. But it includes such things as what is the general economic condition in which we're making these decisions. Not what happened in the past, what we think is happening in the future, but what's happening right now. And so that is something to take into consideration. Are we in a period of inflation or deflation? We haven't seen inflation very much in recent years. It's really non-existent, but that's something that I know that we always talk about, and I have a lot of clients who are worried about, are we going to see inflation anytime in the near future? But that's something that is part of that duty of care. Taxes. Do we have any consequences of taxes? Now, we are all not-for-profits. That's great. We don't pay taxes. Well, there are some instances where you might be paying taxes. In the private foundation world, we have an excise tax rule that we need to look at whether we're paying a 1 or 2%. If you're generating UBIT, unrelated business income tax, that's a 30% payment of taxes. So when I'm looking at my rate of return, is it really worth it for us to have this investment in the portfolio if I know I'm going to have to pay a 30% tax on it? We're also looking at what role every investment plays. And this is just a general rule that nothing is in a vacuum in your portfolio. So do I know what my equities are, what role they play? Do I know that for my fixed income? And we're going to talk about that a little bit more. What's my distribution need? What is my spending policy? If I'm on a charitable remainder trust, what is that rate that we have to pay out each year? Hopefully it's not an 8, 9, 10% rate from a trust that was created long ago. Hopefully it's a more reasonable rate, one of those 5% ones. But some of those older ones existed, and that's something we're dealing with. I know at our institution, Chris and others are dealing with at theirs. Those trusts are coming up upon exhaustion, and what do we do and how do we educate not only the not-for-profit client, but the donor about that consequence? What's our preservation of capital? What's our need to preserve capital? And on the distribution, do we need to spend? I worked with some not-for-profits that don't spend their amount, their 5% every year. They actually kind of put it in the bank for that rainy day. And then when they had the rainy day in 2008, 2009, and even 2010, that's when they took their spending because they hadn't used it in previous years. And do we have any special needs? Do we have any donor restrictions? One of the things that MIFA is really conscientious about is donor needs and donor restrictions, making sure you understand the pros and cons of those restrictions and are they really in the best interest of the not-for-profit. And then the duties to manage costs. Do we know our costs? Are they reasonable? I'm one of those who believes that if we're not paying any costs, sometimes we actually get what we pay for. So I think it's okay to pay for services, especially those you need, whether they be a legal counsel or an investment manager. The duty to verify. If we look at the facts that are available to us, can we actually verify this information? And the duty to diversify, that is all throughout at MIFA, and we'll talk about the importance of diversification. And then suitability, and that really is with a piece of property that the donor gives you. So if a donor gives you stock, in most instances, we sell that in the not-for-profit world. But there are some instances where the donor may say, we want you to hold on to this. Either they're loyal to the company or they have some relationship to it. Then you really have to weigh the pros and the cons of whether holding that stock is really suitable for your organization. The same is true of real estate. Those would be the two instances where suitability really comes into play. MIFA also talks about investment manager duties, and the one thing that MIFA did is it really allows us and encourages us to use professional money managers. Even for small organizations, for example, I serve on my church council. We just got our first endowment gift. Everyone is just beside themselves at our small church, and they said, Heidi, do you want to manage this money? And I said, no. Let's look to Thrivent, let's look to ELCA, let's look to someone else where we can pool this investment and really maximize what we can do. Because I don't think that anyone who's an individual, especially if they serve on your board of directors, should be managing the money as an individual. Perhaps their company can, and again, that goes back to your conflicts of interest, but individuals, probably not. The other thing that, what that means is you then have to go through the RFP process. And we're not going to talk a lot about the RFP process to find a manager, just to know that you really do need to look at their qualifications. You need to ask questions about what is your experience with other not-for-profits? Are you familiar with MIFA? Do you have other clients who have endowments, charitable gift annuities, charitable remainder trusts? It's really, really important to at least ask those questions and ask for their AIMR numbers, AIMR. And that means if they show you their AIMR numbers that you're really comparing an apple to apple between investment managers, because it's a regulated way for them to actually show their returns. And so you want to know if their returns are AIMR compliant, and that way you know that you're comparing, when you're comparing various money managers, that you're looking at the same numbers. The other things that your investment manager should be responsible for are listed on this slide. And I will tell you again, I think there is nothing wrong with including one page in your investment policy that lists these responsibilities of the investment manager. That way they are aware of everything that they're responsible for, and they're also aware of what the board of directors is responsible for. So they're going to invest in accordance with the investment policy statement. MIFA requires everyone to have a written investment policy statement. And that's one of the things, if you don't have that, most not-for-profits should have that, but even for our private families, we need to have a written investment policy statement. They need to be exercising their full investment discretion, which means they have the ability to buy, the ability to sell, they have the ability to vote proxies for you. We're going to make sure that they're communicating any changes with us. Are there changes in their ownership? Are they being investigated for anything? If they are, then they need to notify us within 30 days, and that needs to be set out in your investment policy. If they're non-compliant, they need to notify you and tell you why they are non-compliant. You need to know what their liability is, that they have fiduciary insurance. You assume that they do, but it would be a good thing to just ask for that in writing so that you have verification of that. And then last but certainly not least, I would probably set out your meeting schedule. How often you want to meet, what are we going to look at when we talk about performance evaluations, who's going to be present at those, not just from the investment manager side, but who's going to be present also from your not-for-profit organization. Because that's where we're really going to judge the effectiveness of our money manager. We're going to look at their performance results. Diversification. Probably one of the best things that could ever happen to us is diversification. But it's really crucial in risk management. As I said before, your portfolio, the pieces of a portfolio don't operate in a vacuum. They all have a specific role. And when some things are performing, other things aren't going to perform. But then, if the economic world changes, they may switch around, and that's why you have different pieces in your portfolio. One of the first questions your investment manager should be talking to you about is, what is your risk tolerance? What kind of risk are we willing to take? And this, it goes back to that whole duty of loyalty and care. You know, if we're a small endowment, we're probably not going to take as much risk as if we're 100 million, 500 million. Even in my world in the private foundations, if I have a private foundation that's only $1 million to $5 million, we have a different strategy than if you're going to be 5 to 15 million, 15 million over. And then I have a couple of foundations who are $90 million and above, and they can take more risks. They can have things that are more illiquid, because liquidity is always an issue for us too. If we need to actually spend something, do we have the dollars available to actually write checks? And diversification, as we said before, is just a part of what we call modern day portfolio management, of looking at total return. You know, when we're striving for return in the not-for-profit, what is it we're really looking for? We're looking for a return that's really greater than our spending, inflation, and the costs. Now, in my world, the private foundation world, we have to spend at least 5% of fair market value on the last day of our fiscal year. So for us, when we look at that, we're trying to strive for at least an 8% return, which is hard. But I'm looking at that usually over a 10-year average, because I know I'm going to have good years, I know I'm going to have bad years. And for some of our portfolios, the oldest foundation that I work with right now is 111 years old. If you want to talk about the power of investing, it's kind of interesting numbers. It's called the Jacob G. Schmidlack Trust. It was created in 1903 by a former president of Fifth Third, actually our first president. It was funded with $500,000 back in 1903. It's given to charity every year since then, except during World War II, which most foundations and trusts during that time didn't make payments during World War II because they didn't know if the world was actually going to exist. So everyone really hunkered down. But if you think about it, it went through the Great Depression, it went through declines in the stock market, and with all of that gifting, it hovers today around $56 million. And so I always like to tell that story when people are talking about legacy giving. But it was important, and it's hard when you've got a $56 million foundation to not try to overspend, because people get really excited. They're like, well, we made 15% this year, why can't we spend more? Because we're going to have some bad years, and that's really, really important. But diversification helps us all get to those goals. Your written investment policy is going to talk about diversification. MIFID does make an exception to diversification, and that if it's in the best interest of the donor. You have a donor, again, who's asking you to retain something, you're hesitant to do so, and what's really interesting is in MIFA, it says you can take into consideration if you're trying to get another gift from the donor as what is in the best interest of the charity. So they're giving you a lot of leeway, but again, I'd probably weigh the pros and cons of this. And then most importantly, diversification is all about asset allocation. What's in our portfolio and why? So this is the thing that's probably been the most intriguing to me, because everyone needs to understand it. So at most not-for-profits, it's our finance committee who's probably meeting with our portfolio manager. But I would tell you that they should probably meet with your full board of directors at least once a year. And you should have a lot of people present. I believe you should have development staff in those meetings. Especially when I worked at Valparaiso University, development reported up to the investment committee. We also reported up to the fundraising committee, but because we had a large planned giving pool, which was charitable remainder trust, pooled income funds, and charitable gift annuities, which were investments, we actually reported up to the investment committee. And I remember going to my first meeting. You know, again, I come from the law world, not the not-for-profit world, and I was in a room with a bunch of men, which was very common at the time, long ago and far away. And I gave my presentation, and they said, "You can be excused." And I said, "Excuse me?" And they said, "You don't need to stay. We're just going to go over, you know, the numbers of the endowment and the investment portfolio." And I said, "Why wouldn't I be here? These are the numbers that impact our donors. If I have donors who have large gifts with us, we need to communicate to them about how their portfolios are doing." And that was a real huge shift for everyone. But in the end, we even started taking our investment manager out to some of our larger donors who had 5 million plus charitable remainder trusts with us, so they could at least have an annual one-on-one with the investment manager to talk about how the trust was invested, what it was doing, because I always thought it was better to hear from the professional rather than to hear it from me, the lay person, because I knew that things would be lost in the translation if I was the one to just communicate with them. But in our asset allocation, we're going to talk about what's our target. Is it 80-20, 70-30, 60-40, 50-50? What does that mean? It means what are we going to have as our equity portfolio and fixed income. Now, I have some clients who do not believe in fixed income. I have one client who hates fixed income, and so in his own personal portfolio, he has no fixed income because he can also tolerate the risk of being invested in equities. However, when he sits on a not-for-profit board, he's all about fixed income because he wants to really lower the risk for the not-for-profit, and he understands there's a difference between investing personally and investing when I serve on a not-for-profit board. The other thing that's interesting about this whole idea of target allocation is, I'll talk personally, so at Fifth Third, for a lot of our foundations, we were 70-30 for a really long time. And then about 8-9 years ago, we took that leap to 80-20. And part of it is because we know we have that 5% spending we have to do. And what we did recently, and we do this every couple of years, is look at the risk of reward versus investing in 70-30 versus 80-20. And then say to ourselves, is this the way we still want to be? And however you turn out, I think that's okay. What I think is really important is the conversation and the exercise of going through what are the risks and rewards of all of this, whether it's our target allocation, what are we investing in our equity portfolio, is it large, small, mid-cap, are we an international, emerging, domestic? One of my pet peeves with investment managers, do we have any investment managers in the room? Okay, well, it's not applicable to you, is that okay? Is when they use investment language that no one can understand except them. So I remember sitting in a presentation with an individual on their private foundation. The family was there, and they were talking about QE2. So remember, everybody was all big about QE2 and then QE3, and I knew what it meant, and I was just waiting for the question because I knew this client really well, and he said, what in the heck does the Queen Elizabeth or Queen Mary have to do with our economic state of affairs? And the investment officer realized he was using a lot of lingo and throwing it around, and they didn't understand. So the first time I was in an investment review and an investment manager started talking about the pigs, I was the one who actually raised my hand and said, could you just tell us who the pigs are? How many of you know who the pigs are? Portugal, Italy, Greece, Spain. And then they started talking about the BRICS. And so Brazil, Russia, India, China, if you want to add a K, Korea. And so, one thing I would say is when you're talking about asset allocation or anything with your investment manager, make sure that everybody understands the lingo. But they need to understand each of these components and why it fits into your portfolio. On real estate, MiFID tells us that you cannot have a direct interest in real estate unless it's related to mission. And I think that's really, really important. If we want to invest in real estate, we can invest in a REIT, or real estate investment trust, which is a very good way for us to be exposed to real estate, but not have that direct investment. And then the world of alternatives. 10, 15 years ago, we really didn't even talk about alternatives, but they've been all the rage. I have some clients who have 25, 30% alternatives in their personal portfolio. I would tell you that's not where it should probably be for a not-for-profit organization. And in the alternative world, what is it we're really investing in? Is it commodities? Is it hedge funds? The other thing I would probably ask about alternatives is it a core diversifier or is it opportunistic? And if you ask that question, they'll go, how did you know about those two? That's usually the question I get. But a core diversifier means it acts like fixed income. It lessens the risk for us. And there are certain alternatives who do that. An opportunistic one is where we're looking for growth. We're looking for return. And so even with your alternatives, you need to know what that is. So if you think about your own board of directors and who's on your finance committee, I would say education, again, is the key to success for everybody about understanding what these are and how they play a role. The investment review, we talked about this, who should attend? It really needs to be your investment committee, your board of directors, I say put the development staff in there. I say put the finance people in there so that everybody is really on the same page. This is not the battle of the Hatfields and McCoys between development and finance. This is about a team working together. Because I've seen this even in my own institution. Sometimes when you get really large, you're actually competing more with yourselves than you are for the ultimate goal. And so if there's ways that we can all work together, I would say the investment review is the one place. How frequently should they happen? Really depends. I would say once a year is not enough. It might be semi-annually, it might be quarterly. For some of our clients, they will do what I would call a full investment review 2 times a year, and then really get just market updates and performance the other 2 times a year. In our organization, I actually meet monthly with our portfolio managers just so I understand what's going on in the world around us, but we only look at performance 4 times a year. Because again, we don't do things really reactive or short, we do things more long-term, but I at least want to be aware so that if a conversation arises with a client, I know how to respond. What should be reviewed? They should be talking about the market, they should be talking about domestic, they should be talking about international, they should be talking about performance. They should probably be giving you a 1 month, a 1 year, a 3 year, a 5 year, and a 10 year, and you should look at that versus your benchmarks. And your benchmark should fit how you are invested. And this to me is something that I really struggle with some managers. Give us a benchmark that actually means something to us. If the benchmark isn't applicable to how you're investing, then how can I really compare what your performance is and see whether you're doing your job? But those are some of the things that we should be reviewing. The investment policy statement, we should review it once a year. There's probably not going to be a change, but it's a good exercise for everybody to partake in to kind of reinvigorate us and to make sure that everybody is still on the same page of how we're investing. For us this year, our overall asset allocation didn't change, the 80-20, but what makes up the 80-20 actually changed. And so we went through a lengthy presentation about what those changes were, and then we actually revised that page of the investment policy to accurately reflect how we were going to go forward for the next 5 years. And then what should be communicated to donors? You know, I look at annual reports. I love annual reports that we get from the not-for-profits that we support. But the one thing I would like to see is how are you doing on your investments? Actually give me a little bit of return information. You know, when you're in your investment review, you're not always going to be hitting your targets. And I think one of the most important things your investment manager can do is explain to you why you didn't hit, or what is underperforming, or if something is overperforming and it's an anomaly, tell us why. Did something happen in this company recently that made it outperform? If we're going to be trimming back on our portfolio, what is it we're trimming and why? Those are things you should be talking about. But when we communicate with donors, you know, I think it just shows good stewardship for all of us to talk about that we're monitoring our investments, talking about how the endowment is doing, and individually. So if you have donors who have individual trusts with you still, you know, 2008 was a really rough time for them, especially if they had a portfolio that on average lost 50%. And that really impacted their payments coming up on the next year. But for those of us who really communicated well, communicated often, and I would tell you honesty is always the best policy with them, and we talked to them about what was happening, those are the people who had less donor issues. And for me, what happens after the gift, the stewardship, is just as important as what happens before the gift, because these are really, if we're talking about donor-centric philanthropy, we really want to keep moving donors with us. So they started as annual fund. They do major gifts with us. They do planned gifts. They continue to support us. And so good stewardship really gets us to that ultimate goal of doing the best that we can do, not only for our organization, but also for our donors. A couple of landmines. These are the things that keep me up at night, besides having a 7.5-year-old who acts like an 18-year-old most of the time. So these are the things that I am always aware of, and I'm surprised how many other people aren't probably talking about them. And so the first thing to me, when we talked about it a little bit, is the unrelated business income tax. And so basically, again, this is a 30% tax we have to pay. it's come under a lot of scrutiny. So it's not prohibited per se for not-for-profits, but as you know, if you read anything about what's happening in Washington, what's happening with the IRS, or the total disarray that the IRS is in right now, UBIT comes up a lot. In my world, it plays a role, and how I like to talk about it with people is it really worth the risk versus reward. So if I know I have to pay a 30% tax, when I look at my rate of return, what is my real rate of return? Because UBIT will do a couple of things for us. One, it requires me to file a 990T. Also, we get our reporting on a K1. So anytime you have alternatives, if you're in some hedge funds and you're waiting for a K1, K1s don't come out just on December 31st. They come out at all different times of the year for different money managers, and it can really delay the preparation of your tax return. To give you an example, we have some foundations that have a September 30th fiscal year end. It means that our tax return is due February 15th. We did that by purpose because it means our tax returns are usually done before December 31st. They get them done before personal returns. When we invested in alternatives, we did a huge analysis about how delayed our tax returns were going to be because of certain alternatives we wanted to be in with some large portfolios. We know that on some of those accounts that had September 30th fiscal year ends, we will not be getting K1s until the end of August, which means we're going to be filing our returns almost a year late after fiscal year end. Now for us, these are trustee foundations. We can calculate out what the distributions are. We've got the means to handle that situation. If this were a not-for-profit organization or an individual client, I would probably have a different conversation with them and make sure that they fully understood everything that was happening and the implications of having something that generates UBIT in their portfolio. So it's just something to be aware of. Self-dealing rules. Self-dealing rules intrigue me because they apply to all of us in the not-for-profit world. They apply to trusts, but the private foundation self-dealing rules are even more complicated. And what I tell clients in the foundation world is, if you think you can do something, you probably can't, because there's probably a rule against it. It is the most counterintuitive place I've ever worked in my life, and that's coming from a lawyer who has dealt with rules and regulations most of her life. But it's something to be aware of. Again, that's why we have our conflict of interest policies in place. Jeopardy investments for private foundations. If you don't work in the world of private foundations, you probably didn't know that there's a specific rule about Jeopardy investments. And it basically says you can't invest in anything that jeopardizes the well-being of the private foundation, which means we can't take undue risk. It doesn't prohibit it per se. In fact, the IRS code lists certain things as, quote, Jeopardy investments, and it doesn't prohibit you from actually embarking upon them. What it tells you to do is to have a robust conversation about the pros and cons and document it in your minutes. So you can invest in some of these, but you need to have a really good conversation with your investment manager, your board members, and it needs to be documented in minutes in case you're ever audited. I actually have this coming up right now with a foundation because I have a client who died and he left about $9 million worth of company notes to his private foundation that are generating income. The foundation was only about $3 million to begin with. So now we have a $12 million foundation, which has to kick out 5% every year. And so we're looking at some liquidity issues and making sure that our stream of income is enough. Again, the question raises, what happens if all of a sudden one of your notes goes bad and they don't pay on the note? And so we've hired independent legal counsel to kind of help us with this, but that's one of those situations where all of a sudden we're more illiquid than we are liquid in the portfolio, not through something that we did, but because of how it was designed. And then last but certainly not least, this whole idea of public good. I think this runs through everything we do, and that is really the notion that when we give money to a not-for-profit, whether it be a public charity, whether it be a private foundation, you are now putting it to use for public good. You've released all of your personal interest in this, and it is now going to the good of community. And what that tells me is we probably shouldn't take undue risk. We probably need to be slightly more conservative. In fact, when you think about where you hear investment complaints, it's not because people were usually too conservative, it's usually because they were a little too aggressive with things, got a little too excited and a little too creative at times. That's why I like to call it creative investing. And so we really need to make sure that everybody understands that. And I think most people do, but sometimes we just have to take people back to that simple statement to really help them kind of see the light in terms of how we're investing at the not-for-profit and how that might be actually different than what we're doing in our personal portfolios. Remember my client who loves, equity so much, he's 100%, but when he sits on a not-for-profit board, he's the first one to talk about how are we going to reduce our risk, where's our fixed income exposure. And the last thing, and I talked about this before, this is really about stewardship. This is about being a good steward to our not-for-profits. This is about being a good steward to our donors. I would tell you, utilize your investment managers when you need them. If you need them to go out on a donor call, then use them. If you're not willing to use them for some reason, then I might think about whether that's the right investment manager or not. Are they going to present them with 22 slides of economic charts? Or are they going to be able to actually communicate them in a really clear manner about what's going on, the good, the bad, the evil right now? And I would share news with clients and donors, whether it's good or bad. Because usually, even when there's bad news, there's usually some good news. So I have to tell you a story. I have an investment manager who likes to start out with all the bad news. And I don't know why. I think that's okay. And the client has gotten used to this. But he gives what we like to call the Eeyore version of investments. So it's usually, well, let me tell you what's wrong in the market, and let me tell you why this is down. And then he goes, and now let me tell you the good things. And so I think, again, you have to kind of know who you're dealing with, but there's good and there's bad. And so I wouldn't sugar it with any of my clients. Again, I think to be a good steward, they have to know what's at play. They have to know what jobs mean right now, what the employment rate means. I think they have to know what we're watching for right now, what might cause us concern. I have one client who in every investment review wants to talk about the price of gasoline. And that's okay. And if any of you have purchased gas in recent months, you know that summer is upon us because gas went over $4 a gallon in Ohio the other day. I haven't filled up here yet, so I'll know when I go back. But we need to share the news, whether it's good or bad, because that's just really a part of being a good steward, not only to our very trusted donors and clients, but also to our not-for-profit organization. I told Steve I'd be done at 3:25. It is 3:25. But I will take a moment for questions or answers, and I'm going to stay around for the other side of the sandwich. See, I'm in the middle of the sandwich. You got the presentation after lunch. You have one more to go before cocktails. I'm staying until cocktails. I hope you do too. So does anybody have a question that's pertinent for the group right now? Hopefully you got not only 1, 2, maybe 3 things that helped you in your daily life that you could take away. So I hope this has been helpful to you, and I just want to thank you all for inviting me back today. What I love most is coming out and seeing all my great friends. I think it's been about 2 or 3 years since I've been here, so hopefully you'll invite me back again, but thanks. And don't forget your highlighters.
We'll take about a 5-minute break and go right back into session.